What's up, everybody? Nick Powell's publisher of 1851franchise.com here for 5 secrets to finding multi-unit franchisees and ultimately selling them. I appreciate you watching and look forward to giving you some sort of insight that hopefully you can cross-apply, especially if you're looking at the multi-unit conference next week and how can you get the most out of that conference. Today, I'm going to go through the five secrets. You're going to learn them. But I'm also going to share with you some real insights as I picked 3 brands that are not clients and decided to look at their footprints and their opportunities. I'm going to go deep on one of them just to show you what I see. Now, this is not me actually buying a franchise. When I take you through this is me showing you what I see as a candidate. Real truth, I am, and I've told this joke many times, I am financially sound enough to buy any franchise, maybe not a professional sports team. But because I look at what could make a business better, I might be too much of an entrepreneur to fit most franchise brands. Unless it's as a passive investor, but I'm going to walk you through that. Okay, so secret 1 is I put as the category of your offering and your budget. And so step 1 of this is the return on investment. So I think a lot about this, that there's so many franchisors that we work with or have worked with or are out there in the world, or the ones that are going to be exhibiting at the multi-unit conference, and they definitely want deals. Everybody in franchise development, the toughest thing about your job, there's 2 things. One is you're only as good as your last deal. That nice little pat on the back, maybe a little bit of commission, and they're like, okay, go give me another one. That's a tough life to be in, because there are no lights at the end of the tunnel. Like, you're just constantly fighting to grow a business. Unless you obviously have equity in the company, then there's this fantastic light at the end of the tunnel. And then on the other side, we're trying to sell a business that the buyer has little to no control over. They're buying a business that has already been established, and of course you want them to follow the system. And of course, the best franchisees are the ones that actually do follow the system. And so this is not an easy thing to sell, but I'm taking the sense of you have a booth at the multi-unit conference. How are you going to work the candidates that get through there? And so again, number 1 is return on investment. It has to be sound. So could you sell a franchise, and are franchises sold every day? They are. But when you award a candidate who is going to outperform averages and be one of your higher performers, then the return on that investment is so multiplied that the impact back to the business ends up being tremendous. So there are many brands here, and I could go through every brand at multi-unit, which I'm looking at the screen. I'll share this with you in a minute. I'm looking at all the exhibitors. And if I went through all, call it 500 brands that are going to be at multi-unit, and said what percent have a really strong return on investment, 20%. Now that's still a lot, but that means if there's 500 franchisors, which I don't know that to be the exact number. But I'm going to use it for easy math. 500 franchisors, 20% have a good return on investment. That means there's 100 brands in the world, in the room, that are going to be the viable investments. And then there's going to be 400 here where your investment doesn't compare well to others. And therefore, if I'm a multi-unit operator who is even possibly considering another brand because the inventory of my brand is gone, then it has to start with that. Now, how do we know whether our investment is good? I mean, from my lens, I'm looking at typically a 3-year return on investment, meaning if I took every dollar that business kicked out, could I pay for that investment over the course of 3 years? So the year and 4, year 5, etc., I'm making money on my initial investment. Maybe not a ton, but it's starting to roll forward. That seems to be a good governor on what is a good investment. But the way, if I'm sitting in your shoes, and especially if I'm exhibiting at the multi-unit conference, I'm taking my investment, let's just say it's $1 million, and I'm not looking at just competitor brands first. I'm actually looking at other investments that are $1 million, and then I'm starting to fill out my chart. How many hours do we expect out of the operator at each of these $1 million investments? What is the gross revenue? What could be the projected profitability on an annualized basis? What does year 1 sales look like? What is the profitability on year 1, 2, and 3? So we can see what's that ramp up period. And so that return on investment ends up being such a critical piece that if you do not have a sound return on investment, then you are selling more on the emotional side than the financial side. And the multi-unit operator, especially if they're coming from another brand, tends to have a different degree of sophistication. And so you're going to be playing from behind. Okay, let's pretend you all are smart enough. You can look in the mirror and say, is this a good investment or not? Let's say it has a little bit of mud on it. Well, then the way that you're constructing your offering, your marketing, your booth, the way that you're presenting yourself might have to swing more on the emotional side. And so empty buildings, which drives me nuts. Just look at our product without people eating it. Like, you may have to rework it. Now, are you going to rework it? It's Friday. The conference is Tuesday. Are you going to rework this by Tuesday? No. But you can at least start setting your own expectations on, do I even have an offering that's going to get in front of the right operator? Now, sometimes, and it takes the reworking of a business model and different lenses, sometimes the reason the return on investment isn't strong is because the cost to get in is too high. And sometimes you can look at the building and go through the exercise of, if I had to go start this on my own, how would I bootstrap? What would be the shortcuts that I would take? Maybe the fixtures aren't the same. Maybe I cut some of the menus, so I don't need the equipment in the back. Like, how do you start shaving the expenses down to make the investment sound? And this is where, when we're consulting with a brand, we tend to start at some of these levers to see, there might be some sacred cows, but what can we do to make sure that the cost to get in is sound with the potential of what you can make? So that's one under offering and budget. And offering and budget is the first secret that I'm unveiling. Number 2 is proper qualification. I've said this before. I would like to qualify candidates who can open up 3, enough to open up 1, enough for a rainy day, and enough to scale. When a franchisee limps into the system, signs a big multi-unit agreement, in my opinion, you just took their capital that could have been growth capital. You just allowed them to lock up a territory that went, especially brick and mortar, gets involved in that marketplace. There's going to be other franchise buyers who want to come in because they're going to see the product in their marketplace and they're going to be told, no, they cannot buy in. And so when you sell these big multi-packs, in my opinion, you actually hurt the growth potential on the 2 sides. One, you've taken capital away from the franchisee that they could have used as operating capital. And 2, you've tied up the marketplace, which means you're going to have to reject franchisees. And so proper qualification comes to, let's award in a way that is going to be scalable for them and scalable for us. Now, that doesn't mean you don't give first right of refusal in a marketplace. It just means you might adjust the way that you're qualifying a marketplace. So now when you see these press releases, 50-unit deal, I would place a very large wager that majority of those deals never come to fruition because the deal is too high. You've locked out other franchise buyers. they might open 1, 2, 3, 4, 5 and then stall out. And now you just tied up 45 other potential units, even though the consumer brand is building. When I've really dove into brands that have growth room outside of core states, the aligned expectations end up being the biggest issue that prevents a brand from going from good to great. Let me explain. If a pizza brand, I'll tell you a real pizza brand. I'm not going to use fake ones. We worked for a long time with Topper's Pizza. What was beautiful about it is majority of their stores were in Wisconsin. You could see what the average unit volume of the stores in Wisconsin were. You could see what the average unit volume of the stores outside of Wisconsin were. They were not in alignment because of all the built-in brand awareness. So now when you're looking at an item 19, shouldn't you start breaking out to set the expectations? Because aligned expectations ruin your chance at getting that growth in that multi-unit operator, the scaling franchisee. Because if you sell based on a big fancy item 19 and their sales don't align to that big fancy item 19, then now you've just destroyed your return on investment, the proper qualification is off, and your brand stalls out. And so that's why the way that you're aligning the expectations and being critical. I was talking with a donut brand last week. This one I'm not going to call out because it is not a strong investment in the current standing. I said, look, if I were you, I would take the crumble approach to your donut model. You have beautiful toppings on top of your donuts. I would rework the model. He said, crumble is failing. I said, okay, so maybe there's some PR on them closing locations, but are they closing locations because they're failing, or are they closing locations because the expectations are misaligned? They sell on a big fancy item 19. You hear franchisees in urban, very heavy, high density markets talking about their volume of customers. And so now I open up in a market that doesn't align to the franchisees who I qualified against or the numbers in item 19. I'm disappointed. I stall out. I stop growing. I close my doors because I limped in there. What could be the issue of crumble closing stores? It's the proper qualification and clearly the return on investment, but it's the aligned expectations to say, here's what first year sales are. Here's what sales are in tier 1, tier 2, tier 3 markets. It's giving a little bit more data so that the expectations are aligned. And we're still under offering and budget. Then I get to, what is the value of a multi-unit franchisee? And so if the FDD gives numbers, and I'm going to actually show you two sides of this. Let me do it this way. Let me actually share my screen now. And for the record, I see there's a bunch of you watching. If any of you have questions or you want me to look at your brand or get specifics beyond what I'm talking about, go ahead and just ask a question. I'll see the comments come through. Okay, so what I did, you're going to see my chart of material up top. I took 3 brands that we don't work with, and I'm going to show you just how I look at it. And this is not to be offensive back to any brand. It's just to show you the way that I would look at a brand. So I am a big fan as a consumer of Naf Naf Grill in Chicago. Big fan. And so what I did is I'll take you on their journey first. I'm going to come back to messaging in a second, but what we're going to do is what I did is I searched for Naf Naf in Google News, and I came across this great story that they signed a multi-unit franchise agreement. And so here, Roma Patel, a prominent multi-unit operator, they operate 20 tropical smoothie cafes. Okay, so they bought into the business. So I took this, and I went on to Wisconsin and looked for the FDD filing, and I pulled up the FDD. And I want to show you a few things on how I look at this. So they signed up for a 4-unit agreement. And so I want to look at this in 2 ways. The lens of what is the value of this franchisee back to Naf Naf, as well as what is the potential return on investment and how could potentially the multi-unit operator in this sense be looking at the business, and is there alignment in how I'm saying. and what I'm saying. Love the category. Again, I said I'm a fan as a consumer, so that already hits the mark. So the two things. First, let's look at it, the FDD for someone who owns 4, to say what is the return on investment, proper qualification, aligned expectations. So proper qualification is clearly here. This group owns 20 tropical smoothie cafes. That is giving them plenty of cash flow that's kicking off of 20. Shows that they know how to go from 1 to scale, which is rare. So qualification is good. Return on investment. So what I did is I took the 813. I tend to look at the higher numbers. This sets expectations properly. So we have $813,000. I multiplied that by 4 to get the 4 restaurants open. It's going to be a $3.2 million investment. The first thing that I'm going to pull just as a benchmark, when I look at item 7, I like to look at grand opening expense, which I guess that's their marketing introduction program. The way that I look at a grand opening expense, and I am in the minority on some of these opinions, but again, my opinions are designed to hopefully build a better offering so that the franchisee success only ticks up. So their market introduction program is 10 grand. I like to look at marketing as our expectation should be a 3x return on investment. So 10 grand is going to equal $30,000. In my opinion, the grand opening should be 10% of the total investment. When we're talking about an investment that's going to hit $800,000, what's $80,000? And if $80,000 is spent, that should get us about $200,000 in return. So that is all money that's going to drop back to the bottom line as a part of this. I also look at the additional operating funds between $10,000 and $40,000 for those 3 months. Are we really looking at someone that only makes $120,000? I look at that as somewhat of the income replacement so that their lifestyle remains the same. And again, when you have 20 tropical smoothie cafes, you're not overly concerned about cash flow, I would assume. But I tend to look at those two things. So hold on to that $10,000. I'm going to go down to their item 19, and I'm looking for insights that we can discuss later. So let me show you what some of the things I look at. I looked at the company-owned stores, $1.2 million, great. Franchisee-owned, the average is 839, 1.4, 430 on the lower end. We're going to still use averages, hopefully outperform it. So we're going to use the 839. So at 813 investment times 4 is a $3.2 million investment. If we had all 4 of them open on day 1, if these numbers are accurate, which they're probably not for year 1 sales, but we're still going to use the average because the highest is hopefully that where we're going to get to. So the 839 would be $3.35 million. Now, at $3.5 million, and I do like that some of the data starts breaking down. And so we get down to our earnings before interest, taxes, depreciation, et cetera. So 28.1%, and before rent expense. So what I did is I took, I'm going to keep scrolling down here, 5% royalty, 2% marketing, 1% ad fund, and the tech fee, that six grand out of 800 to give a number. So now at 28.1 minus 8%, see the 8 right here, 5 plus 2 plus 1 minus the 2% for the additional tech fee. And then I took a 12% on rents. And so what that does is it gets our number down to 18, about between 6 and 8% on that number. But if we were going to bump it up to $1 million in sales, I'm just coming up with a number of, well, we should make about $150,000 a year on each restaurant. So times 4 equals 600,000, which equals a 5-year payback on the initial investment. But why would this make sense here? Franchisees, they operate 20 other restaurants, so they're well capitalized from those. And then that means in 5 years from now, Naf at 5 or 10 locations could be paying off between $600 and $1.2 million above cost. And then you could also unwind the Tropical Smoothie Cafe portfolio. So I understand why someone like that can buy into it. So what would drive these franchisees to buy into it? I chose to go into the business because the brand has tremendous growth potential. Agree. A unique and high quality product and a strong support system. Okay, so here's an insight from a multi-unit franchisee who is telling you the roadmap. They are giving it to you right there. They're telling you what do you need if the investment, let's just call it a 4 to 5 year payback on investment, which is north of what I wanted to be at 3. Why are they buying into it? Growth potential, they like it. A unique and high quality product. They can see a point of differentiation in the marketplace, and a strong support system, which starts with the leadership team and it brings it down. Now I'm gonna jump over because now we've kind of cut through the offering and budget, which the secret is have a good return on investment. Make sure you're properly qualifying. Don't give up too much real estate. This is only a 4-unit deal. Align your expectations. NAFTA did a pretty good job on disclosures within their item 19 to give at least some back of the napkin numbers. Understand what the value of that multi-unit franchisee is. This is part of the magic. And so let's take that 5%. We got a 3.35 million. See my big fancy calculator times 0.05. It's that franchisee with 4 units open is worth $167,500 a year. I'm going to multiply that by just 3 years, and that's going to drop $500,000 in royalty back to the business. And so I've said this so many times, for $500,000, what would you be willing to spend to go acquire them? I would be willing to spend $167,500 to go acquire them. Man, imagine that, franchise development teams. CEO says, I'm going to give you $167,000. Go get me that right franchisee. If I said $167,000 to get a franchisee at a conference, does that change your approach? Of course it does, yet it still drives tremendous return on investment back to the franchisor. And this is using real numbers in the way that I see it. Now, so we return on investment, proper qualifications, aligned expectations, and the value of the multi-unit franchisee. We've just worked through that to understand this. This is secret 1. Secret 2 ends up being the buzz, which ends up being the website. So I chose to go in business because of the growth potential, a high, unique, quality product, and a strong support team. Now let's go into their franchise website. About us, not a why you, why now. Our franchising program provides the opportunity to serve fresh, authentic Middle Eastern cuisine in new markets. No, your business is a unique and high quality product, as said by this 4-unit operator. That goes here. A video on the product, fine, I guess that makes sense. Proudly operates in 14 states with additional restaurants under development. No, lift this up. You have the message. What makes us different? Owned and company operated stores. No, that's not what your franchisees are saying. If we're going to talk about something, it was the incredible growth potential. And so now we're talking about, we own 21 corporate stores in 4 different markets. No, we're starting off by saying we've expanded in 14 different states. There's incredible growth opportunity. Dedicated franchise resources. There's some stuff here, but I would use the line that they said. They said a strong support system as dictated by this franchisee, simplified ops and chain supply, white space. That one's a good one, but I would change that. What's new? There's some news. The brochure, for the record, I downloaded it because I'm looking at this as a franchise buyer. Let's share a meal. There's a product, but I'm buying because of the support. Let's not forget that. And we get into, here's the product, which is fine, but I don't know that really matters right now. And then we get into site selection, but it's not answering the points that they said that they want to buy. So if I look at this brochure, I don't see it. And so there's some people in line. That's a better start. Not a why you, why now, not telling me why I want to buy this thing, yet all the insights are here. And so secret number 2 is the buzz behind your brand. I was talking to a candidate recently, or client works with an ad agency, and the ad agency like, we got this client, we got this customer, this franchise buyer in there. Inaccurate. I actually talked with the candidate. I said, how did you find this brand? And yes, do the ads count? Of course they do. I've talked about the combination of everything. We're talking about buzz. Buzz is not one-dimensional. Buzz is multi-dimensional. But I talked to the candidate. I said, why did you look and inquire in this brand in the first place? And he said, I was Googling top brands in this category, and I found the brand. It was coming up all over. If you did not watch my Coffee and Analytics last week on really understand your AI footprint, I'll go watch that. That's a part of this. But secret number 2 is the buzz. PR, content marketing, website, and digital ads. So let's go ahead and we're going to pick brand number 2. And I just picked a random one, another broken egg. Again, brands that I don't work with, so that I could look at it with a clear mindset and nobody can tell me that they paid me to give messaging. So I looked at another broken egg. I first looked at their PR. They're opening here, AOL.com, interesting. Another broken egg, dine and dish, first look. What is this missing? People, and if we go back to the insight off Naf, quality of product, opportunity of white space, superior support. Here's where I started liking things though. Broken egg propels franchise growth with key market expansions and multi-unit operators. Okay, so let's look at who these multi-unit operators are. Looking beyond. We have some openings. No franchisees announced. New market expanded. New multi-unit operators. Who are they? Let's find them. They're not there. Went into their website, can't find franchising at the top. Easy win. This is buzz building. I want to sell to the multi-unit operator. I want to educate them that I'm a franchise. Where is it? Not in this menu. So nothing here, nothing about franchising. So I'm already playing from behind. Let's go down here. Click franchising here. All right, let's see. What is the point of differentiation? In this site, let me see if I can make it bigger because it's not coming. There we go. Breakfast and brunch. I see an empty building. I don't like empty buildings. Chef-inspired, culinary driven. Love that. I think that's interesting. Boost your profit margins with high spirits. Okay, let's see. So what are the spirits? How do those advance? And alcohol. Alcohol's growing sales. They were up 200,000. What percentage of sales are they? So I don't see enough information on that. And so if I look at it, here's some good award-winning, number 2 in the brunch and breakfast segment. And so now when we're talking about buzz, the PR, there's no humans, content marketing, there's not a drumbeat of explaining why this is perfect for the multi-unit. Who are my multi-unit operators? Celebrate them. Websites, you could use some more people, visionary. What's the vision of the business? I can see some good numbers in here. They're obviously extracting some of this stuff. Average EBITDA is 19.1%. This is of corporate cafes. So the question there is, does a franchisee, is their numbers, all their percentages have to come out of that? What does that mean? So there's some question marks on this. And so again, like part of this is to say, I'm setting up the pathway to say buzz, fundamentals, PR, kind of marketing, website, digital ads. Okay, so the last thing I want to check on the franchise. Let's see, breakfast and brunch franchise. So let's just do best breakfast and brunch franchise. Now I'm in Illinois, so this could impact it. Talk about AI, so positive. It's showing up in the AI generated content. Good. No ads. Don't see any ads on them. And another broken egg. Here he goes, a little bit further down. The list, not seeing any ads. So from a buzz standpoint, mediocre grade. And so again, like I'm looking at this as the franchise buyer to give you guys insights that now we got to make sure the blocking and tackling is done from a buzz standpoint. So number one was secret, offering and budget has to be sound. Number two secret is the buzz has to be consistent and align back to the message. The last thing I'll say on the website side is we want multi-unit operators, and let's call it out. Let's show who the persona is. Let's have a landing page that exists on our website. Let's use that as the directive for how we're buying ads. Number three ends up being four-wall marketing. This is secret number three. Four-wall marketing is what does our operations look like? Are there lines outside the restaurant? What is the experience like inside of our units? Does it align to the expectations we're setting? If we're calling us the best breakfast brunch franchise, we're calling us the best Mediterranean franchise, does that relate back to the reviews? Are those coming up in there? When I see on the door franchises available, boring. Make it count. Like we're in the people business. Give me a message. Talk about the owner operator. Put a story up on the wall. Let them be the hero of that unit. Put it on the outside of the wall. Like if you look at architects, they're super proud when they build something. Put the name on there. So the four-wall marketing, if we're finding that next secret, it doesn't cost much. It costs nothing. This is taking advantage of your four-wall marketing because, again, the 5 secrets to finding the multi-unit franchisees is creating the excitement through the four-wall marketing that is backed up by the buzz, that is supported by the profitability and the franchise offering. Now we're starting to understand where we play. And so if you have turbulence in any of these areas and you're going to go exhibit at this multi-unit conference, just understand your expectation should be in alignment with what I'm talking about. Can you sell a franchise? Totally, if the emotional side is there and the hook is there. But this is the fundamentals of making sure that you have the secrets handled. They're not secrets, by the way. They're very, very basic. To make sure that you're impacting your multi-unit operator. Number 4, supply and demand. Speak to the operator target or invest in a franchise sales landing page. Let's look at one other brand. I'm going to look at the Goddard School. Again, another franchise that is not ours. And we're going to look at the franchise. And it's interesting. What I see first is, yes, they're buying their ad. So there's that buzz side. Look at all these other brands that are buying it. They're like, hey, don't invest in a Goddard School. Come invest in us. Now, in my opinion, I think Celebrity actually does a pretty good job at the competitive advertising. But in my opinion, you now need to say, here's our point of differentiation on why our investment, why our offering versus everybody else. So let's get into their website. Early education franchising. We're talking about a fairly big investment. I don't know if they have investment on their site, which is going to be critical. I don't see it yet, but I already know this. That's not a why now. The Goddard Advantage. We've been in business for a long time. Yeah, I think that's good. Community impact. I think that's pretty much everybody. And committed leadership. That's pretty much everybody. And so if I'm creating a point of differentiation, it could be speed to open. It could be the depth of the curriculum. There's something else that is going on there. Honored and as a top opportunity. I don't know what Fund 930 is. I'm sure it's good. They're ranked. Our franchisees know a great investment. What's the investment? Tell me. Our CEO is featured on the importance of quality early education providers, and then back to economic prosperity. Well, I like this. That could be a YUI now. That goes up to the top. Immediate franchise opportunities. Oh, I like this. But I can't click on it. So why can't I click on it? I want to know about Dallas or Detroit. but it looks like maybe these are resales. Show me a picture of the building, not the city. If I live in Minnesota, I already know what the city looks like. Our ticket to a better life through early childhood development. Okay, we multi-unit franchisee, good. Okay, we're trying to go through multi-unit franchisees. That's not them. Let's see if they're on here anywhere. Doesn't look like it. I don't think so. So I would put a multi-unit franchisee right at the top. And so now I'm looking at how are you positioning your supply and demand. I don't know how many schools you have. I don't know where you are growing. Oh, there's the franchise costs. Franchise costs. Initial franchise costs and support fees. Interesting how they break those down, but I don't know the total there. I mean, lots of words. I don't know that helps me understand the business opportunity, but let's see, high growth markets. Let's see if I can click on those. High growth markets. I mean, there's a bunch of cities on here. I'm on a request form, nothing more about the city and why I would like to buy it. That's a good picture on the backdrop. So, I mean, this is where, again, like we're going to spend all this time, money, and energy at the multi-unit conference. Are we doing the fundamentals right to set us up for success? And so if you're putting each of these things into their own buckets, you're expecting a conference to drive its own success. You're expecting the PR to drive its own success, content marketing to drive its own success. It all has to flow together. Like the best opportunities flow in the right direction. We can look at Tropical Smoothie. Let's go look at them. Tropical Smoothie Cafe franchise. Now they've had tremendous growth. So let's go ahead and look at this. I'm going to load that guy up and let's see if they disclose, in Wisconsin, Tropical Smoothie. Okay, let's take a peek at their FDD. Because clearly, I mean, we just saw a franchisee of Naf Naf that does well. So let's look at their total investment, initial fee. I like that. It's pretty low. Franchise fees are getting out of control. Grand opening marketing, I still think very low. Additional funds, 10 to 550. So apples to apples, we're talking about 300 to 720 on this one. And Naf Naf is 400 to 813, so a little bit less on the cost. Let's go ahead and get into the numbers, see what they report in here. Then we'll go look at their website real quick. Again, comments or questions, you want me to go look at your site or give you feedback, happy to do so if you want me to look at it. So let's see. I mean, I do like looking at top restaurants because I want our franchisees to be the top. But let's take a wider range. We'll just do the top 50. Beautiful. 1.2 million net average revenue. That looks interesting. The bottom still 700, bottom 25%, 500. Some of the lower performing ones here are there. Average net revenues, more data, net revenues. Personally, I like to see a little bit more details onto how much you can make by looking at a little bit more of the data that comes behind it. But clearly, they have 1,000 restaurants. I mean, I could tell you what I like to see. They're gonna be like, we already have 1,000. We don't need your opinion. So that's fascinating. Look at that, 124, 160, 174, crushing it. Now, if I want to find states that has some opportunity, Alaska has 0. You want to go open up Tropical Smoothie in Alaska? That looks pretty good. Arizona has added 10. Arkansas looks pretty sold out. California, nothing. Interesting there. Connecticut, very low. Florida, 205. Tremendous growth there. Friendly state. We did a report on the most economically sound states the Alec Lafer report. And let's look at Utah, because it is great. Potentially some good opportunity. Texas, it looks like there's some opportunity here. So even with 1,000 locations, look at Virginia, 120 there. So you can see there's a lot of interesting opportunities available for this brand, and clearly producing pretty well. Let me go take a quick peek at their website. The Passion Powered Franchise Opportunity, not a why you, why now. I would actually highlight, because we're trying to get in front of the multi-unit operator. Here are the states that we have multi-unit operations available, using some of their numbers in here. They should love this. Talk with our franchise owners. They're saying, like, go talk to them. There's proof in the pudding. We're everyone's happy place. I would actually put franchisees quotes on there if I was going to tighten it up, but pretty good business offering. Again, I could dive through those numbers. So last thing, and I think this is the secret to multi-unit operations. I took all the franchisees that we've spoken with who are multi-unit operators, said, what is your buying process? What's important to you? And they said, point of differentiation on the product, vision from the leadership, cost to get in, how much it can make, where are you growing, how are you growing, and franchisee validation. Like that's the simplified process of how they buy. But here comes the last secret: resales. I think resales are the most beautiful part of a franchise sales process. Why? When a sales team gets a resale done, it protected royalty, got new blood in. That new blood is going to likely outperform and have tremendous impact on the business. And so I think resales are the best. And if we really dive into what is the psyche of the multi-unit operator, the majority of the bigger ones, when you say the north of 10 locations in the portfolio, they like distressed or want units that they can take over. They like getting the immediate cash flow. And if it were me, I'm talking to them, yeah, well, we can sell you a unit. We can give you a good deal on a unit if it's corporate, or we can align you with a franchisee and obviously protect the business. But we want additional growth in that marketplace. So sign on for 2 additional locations, hit those development agreements, maybe give an incentive to them. Everybody that's building a multi-unit portfolio wants a good deal. And so it all circles back to profitability. Have you built a profitable offering that franchisees can make money with? We can talk about passion and community and all these things. I think they are important. Brass tacks. Can you make money at this? Cost to get in, how much I can make has to be sound. So to recap, hopefully I've talked a lot more than normal. 5 secrets end up being the offering and the budget. Number 1, make sure your return on investment is good. Your proper qualification is in order. You have alignment on expectations, and you've engineered the value of this multi-unit franchisee so that you're spending properly to acquire the power hitters. You have the buzz going. They say this is how they find businesses. This is how they search for new opportunities. PR, content marketing, website, and digital. Your 4-wall marketing, you go back into your units and you take another look at it and make sure that your lines are good. That is creating the perception of excitement. Experience reviews. Eliminate the word franchise opportunities from your cups and your napkins in your door. Talk about the owner-operator. You make sure you hit supply and demand and create a sense of urgency on your website to talk about the units. Have a rolling thing of units for sale. A very happy success story that I'm proud to be a part of is Paris Baguette, new franchisee signings and openings, connected to content. There's a whole bunch on here. So we have a steady drumbeat of those so that as we get signings and openings, we're showing supply and demand. There's people in the photo. And then resales. Celebrate them. Don't be ashamed of it. Those are big, giant moments. And if you're a CEO of a company and you happen to watch this, or you're in franchise development, send this to the CEO. The resale is arguably more valuable than new blood because it is protecting royalty. It is getting new blood in or additional resources from other franchisees to now hopefully grow those sales, which will make you more on royalty. And it proves the value of franchising, which is that there was an asset that could be sold at the end of this journey, whether it was exactly what that franchise owner wanted before they resold it. or not, it protected an asset versus opening up your own pool company in that state. And I think resales are critical. So now if we take that resale side and say, how does that message translate into our booth? Do we have a pamphlet on our available resales? Because we know that the operators are going to be asking about it at a multi-unit conference. And there you have it. That's 45 minutes on the dot of me talking about the secrets to finding the multi-unit franchisee. Take notes, put it into action, watch what happens, go through the process like a franchise buyer, like I just did, and you too can win at multi-unit franchising. I'm Nick Powles. I am grateful that you spent this time with me. Hopefully I will see you soon. Best of luck. Reach out if you want more help on how to build the right program to get in front of your multi-unit franchise candidates. Take care.